The stock market has had an impressive comeback since the fourth quarter of 2018. So overall, things are pretty good for investors, right? Well, maybe things are going better, but there is one large concern which isn't getting the attention it deserves. Let's take a look. Now, don't misunderstand. I'm not suggesting this is going to lead to a stock market crash tomorrow. However, this issue can result in some large stock losses later in 2019 and beyond. So follow me here. Following the Great Recession, many families went through the painful process of deleveraging, essentially learning to live on a budget. Meanwhile, many U.S. businesses went the opposite direction. They began taking on cheap debt and loads of it. To help the economy, beginning in December 2008, the Fed targeted a Fed funds rate of 0.25%, basically zero. Corporations took advantage of the low rates and loaded up on debt. Now, as you can see in this chart here, the Fed didn't raise rates again until December 2015. With rates historically low during this time, we basically had 7 years of free borrowing, and the corporations took advantage of that and took on huge amounts of cheap debt. In 2007, total corporate debt came in at nearly $4.9 trillion. Through the midpoint of 2018, that number had grown to $9.1 trillion. That's an 86% increase. And as this chart shows, back in the early 1990s, U.S. corporate debt was nearing 43% of the U.S. gross domestic product. In about 2001, it was about 45% of GDP. Again, in 2009, it reached up to near 45% of GDP. Today, the ratio of U.S. corporate debt to the U.S. GDP is slightly over 46%. That's just below its all-time high from just a few months back. So what's the big deal? The S&P 500 is up over 250% since 2009. So who should care about these debt levels? Well, let's look at the Fed funds rate chart we saw earlier, but let's focus on what's happened since 2015. Since the low of 0.25%, the Fed funds target rate has been climbing. Right now, the target rate is between 2.25% and 2.5%. That's about 800 to 900% higher than the low. It's not the absolute level of the change. It's the impact of the percentage change that has occurred. Let's look at an analogy. Let's say you went out and bought all sorts of things you wanted, and your personal debt levels rose to all-time personal highs. For years, you didn't need to worry because your credit card payments were easy to manage at near zero interest rates. But what if your credit card company called one day and said it was raising the interest rate by 800 to 900%? Those payments on your debt would suddenly be a bit more difficult to make. On the corporate level, many companies locked in low rates a decade ago, but 3.5 trillion of debt will be coming due in the next 3 years. That means many of these companies will have to roll over their debts when interest rates are at much higher levels. According to a recent CNBC report, excluding the biggest U.S. companies, the corporate debt-to-cash ratio is now higher than it was in the 2008 financial crisis. Apparently, the riskier corporate borrowers are more leveraged than ever. A recent Financial Times report from Christina Hooper highlighted the risk. Ms. Hooper stated that in the next 3 years, a third of U.S. BBB rated bonds will come due, a wall of maturities that will test the balance sheets of highly leveraged companies. Ms. Hooper also stated that we could see a situation where companies are not able to cover debt service or, when debt matures, obtain new funding at higher levels, squeezing profit margins. Understand that none of this is meant to imply we're about to enter total financial chaos. Instead, we're going to begin seeing a divergence between fundamentally strong companies and everything else. As this mountain of debt rolls over and companies have to refinance at higher rates, it's going to put pressure on earnings. So please continue to watch those debt levels and earnings of the companies you're invested in. So for today, that's ChewDog Charts. Thank you.